Welcome to the Deep Dive. Today we're getting into something lots of you have asked about, and yeah, it can get complex. U.S.-South Korea cross-border tax for 2025. Our goal here is to look at the info out there. Maybe you're a U.S. citizen in Seoul, or you run a Korean business, maybe a startup thinking of expanding. We want to pull out the really key stuff, help you navigate this whole landscape without getting totally overwhelmed. Think of it like your shortcut through a system that sometimes feels like it's pulling you both ways at once.
It's fascinating, really. The basic setup of the U.S. and Korean tax systems immediately creates this potential for double taxation. See, the U.S. has this quite rare citizenship-based system. So U.S. citizens, green card holders, you got to report worldwide income. Doesn't matter where you live. But Korea, like most countries, it's residence-based. Tax residents pay on worldwide income, sure, but non-residents, only on income from Korean sources.
Oh,
So you've got these two different claims on your income, each playing by different rules. That's the starting point, really, for anyone caught between them.
Right. So say you are that U.S. citizen living in Korea. Both countries see you as a taxpayer. Now, I always figure the U.S.-Korea tax treaty sorts that out. Doesn't it have that tiebreaker rule? Look at your permanent home, center of vital interest, all that. Doesn't that just decide who gets to tax you? Make it simple.
Well, that's a really common idea, but it can be a costly mistake. And this is where things get very interesting for 2025. There was a key Korean Supreme Court decision. It clarified something important. Yes, the treaty tiebreaker does allocate the primary taxing rights, using that sequence you mentioned.
Okay.
But, and this is the crucial part, it doesn't automatically wipe out your separate domestic compliance duties in Korea.
So even if the treaty says U.S. resident.
Exactly. For instance, maybe the treaty points to you being a U.S. tax resident. But if you also met Korea's own domestic rule, like being there over 183 days, you were still required to report your worldwide financial accounts to the NTS.
NTS being Korea's National Tax Service.
Right. If your accounts hit KRW 500 million in total, missing that for past years, that could mean some pretty hefty penalties.
Wow.
So the big takeaway is, treaties solve tax conflicts, but they don't necessarily erase all your local homework, so to speak.
That really is a game changer for a lot of people, I bet. Okay, so with that complexity clarified, let's talk earned income. This hits almost everyone. Many U.S. expats know the Foreign Earned Income Exclusion, the FEIE. Lets you exclude, for 2025, about $130,000 of foreign earned income. You claim it on Form 2555, assuming you meet the tax home test and either the bona fide residence or physical presence tests. Seems fairly straightforward.
It does seem simple on the surface, but here's what's often the smarter play for most expats, especially in a place like Korea where taxes are relatively high.
Yeah.
The foreign tax credit, or FTC.
Okay, the alternative.
Yeah. So FEIE excludes income, but the FTC. It gives you a dollar-for-dollar credit against your U.S. tax bill for the income taxes you've already paid to Korea. And since Korean tax rates are generally higher than U.S. federal rates, the taxes you pay in Korea will likely be more than enough to zero out your U.S. tax on that same income.
So you're covered.
You're covered. And crucially, this is really important if you have excess FTCs, meaning you paid more tax in Korea than you owed in the U.S. The IRS lets you carry those forward for up to 10 years.
10 years, that's significant.
It's a valuable asset for future planning. The FEIE, no carryover like that. Plus, the FEIE can sometimes limit other things, like contributing to a Roth IRA or getting the full refundable child tax credit. The FTC doesn't have those limits, and it's an annual choice, offering way more flexibility than the FEIE, which kind of locks you in for 5 years if you revoke it.
That flexibility sounds key. Okay, moving beyond income tax. U.S. folks in Korea have some critical reporting to do too, right? Not just paying tax. First up, FBA. That's FinCEN Form 114. If your foreign financial accounts added up hit $10,000 at any point during the year, you have to file this electronically with FinCEN, not the IRS. And the penalties for missing this are notoriously steep.
Extremely severe, yes.
Then there's FTSE reporting. Form 8938, that one is filed with your IRS tax return. It has higher thresholds, though, right?
That's right. Higher thresholds like $200,000 for a single filer living abroad on the last day of the year. And it covers more than just bank accounts, think direct holdings of foreign stock, things like that.
So you might need to file both.
You very well might. And the reason this is all so critical now isn't just the rules themselves, it's the enforcement. There's an intergovernmental agreement, an IGA, between the U.S. and Korea. Basically, your Korean banks automatically report your account details to the NTS.
And the NTS shares it with the IRS.
Precisely. So trying to slide under the radar, it's just not realistic anymore. Non-compliance is increasingly transparent and easy to spot.
That makes sense. Total transparency. Now, speaking of risks, let's broaden out to businesses. What about U.S. companies doing business in Korea or thinking about it? What should they be watching out for?
Yeah, this is a big one. U.S. companies face what's called permanent establishment risk, or PE risk. Basically, even if you don't set up a formal branch office, certain activities can trigger Korean corporate income tax. Things like having a fixed place of business there, obviously, but also having a dependent agent, someone in Korea who regularly concludes contracts on your behalf, or even just providing services through your employees in Korea for more than 6 months.
And Korea's NTS is quite strict on this.
They take a very broad view. It's about substance over form. So, for example, say you're a U.S. software company, you have a country manager in Seoul who negotiates deals. Even if the final contract gets signed back in the U.S., if that manager is effectively closing deals in Korea, that's a high risk of creating what's called an agency PE.
Got it. Substance over the paperwork.
Exactly. And this ties into other tricky areas too, like patent royalties. There's this ongoing uncertainty. Korea's Supreme Court has said royalties on a U.S. registered patent aren't taxable in Korea if the patent isn't also registered in Korea, but the NTS often disagrees with that interpretation, so it creates this lingering audit risk for businesses dealing with intellectual property.
Okay, so pulling this all together,
Yeah.
what's the main takeaway for someone trying to navigate this U.S.-South Korea tax maze?
Well, the bottom line is pretty clear. You absolutely need proactive planning and meticulous record keeping. Those are your best defenses, whether it's tracking exactly how many days you spend in each country, really understanding what that Supreme Court ruling means for your reporting, or carefully structuring your business setup. The details are just crucial to avoid very expensive surprises.
Makes sense. Be prepared, be detailed. Okay, so for our final provocative thought for you to consider. Given this increased level of automatic data sharing between the U.S. and Korea and the NTS's broad interpretations, what existing financial setup or business arrangement might you have right now that, maybe without you even realizing it, could be triggering a hidden tax exposure, something you haven't flagged up before? Definitely something to think about. That's our deep dive for today. We really hope this gives you a clearer, maybe more confident path forward.